Hey guys, welcome back to another video. I know I've not been posting for a while, but I've been sick last week and I went on a camp the week before that. But today I'm back and I'm going to talk about the Federal Reserve, which may sound a little bit complicated and annoying to talk about, but it's going to impact our life. So basically, the Federal Reserve is going to have a meeting on June 12th, and I'm going to break it down to 5 simple points so it's easier to understand. And on to my first point, which is the Federal Reserve's upcoming meeting and their decision. So on the June 12th, they're going to have a meeting, and their predictions is that they're going to have a 98.7% chance of doing nothing, 1.3% chance of increasing rates, and 0% chance of lowering rates. So this sounds like uneventful, right? Because they're just going to do nothing. But actually, no. This is going to affect mortgages, auto loans, credit card debts, even stock market and cryptocurrency. Because what the Fed decides to do will largely affect the cost of borrowing money. So the Fed is going to keep an eye on the economic growth, making sure that inflation's in check, finding a chance to lower rates. Of course, it won't be so soon. But they're going to keep an eye on it because right now it will affect a few critical points in the financial world based on their decisions. And on to my second point, which is government borrowing and its impact on interest rates. So the US government actually borrow a lot of money in many different ways, from Treasury bills, notes, and even bonds. So all of these different way of borrowing money have different maturity dates, can go from months to 30 years. And based on what the government decides to do, the Fed decided to do with the interest rates, it will also affect the amount of interest they have to pay on these debts. Well, the one I would focus on right now though is the Treasury note, 10-year Treasury note, because this one specifically correlates to the mortgage interest rates. So basically, if the 10-year Treasury note interest rates go up, then the mortgage rates will go down. And if the 10-year Treasury note interest rates go down, then the mortgage rate will go up. So basically, this two has correlated with each other for the past 50 years, so it's a pretty good way to tell when the other one's going to go up or down when the other one was affected. So right now, the mortgage rate is around 7%, and this is reflecting the rates for the 10-year Treasury notes. And on to my third point, which is stock market and monetary policy. So the stock market actually loves free money. What I'm trying to say is that they'll love it if the rates were lower. But lately, the Fed has been already decreasing the quantitative tightening. They went from 95 billion to now 60 billion. And this is good news for the stock market, you could say, because more people are willing to invest in the stock market now, because there are more available things to invest in, because more people are willing to spend money. And also not just people to invest in the stock market, but also businesses. And because it's easier to borrow money now, less interest, and then it will encourage business to grow and expand as well. But I would keep an eye on the 10-year yield, because this one tends to disrupt the stock market and also make borrowing money harder as well. So if the 10-year yield interest rates were to go up, then stock market might just face a little bit of a problem there as well, because it will be harder to borrow money. Then it will discourage the companies to grow and expand, and also discourage people from borrowing money, investing money in the stock market as well. And then my fourth point, which is inflation and its role in Fed's decision. So inflation right now has shown sign of increase in the past few months within this year. So CPI is at 3.4%, core CPI is at 3.6%, PCE is at 2.7%, and core PCE is at 2.8%. And Fed's target is 2%. So basically, it's still higher. And for reference, CPI at the start of this year was at 3.1%. Now it's 3.4%. So inflation has not been doing that well, to say. And the economy does not show any sign of something significantly negative to the point where the Fed has enough data to prove that they can cut rates. And before they do have that, they will not do that. So basically, the labor market is strong, employment rate is steady, unemployment rate is very low, and the GDP growth seems to be solid, economic growth as well. So basically, there's no reason for them to cut rates. And until they find a reason, they will not be cutting the interest rates in the next 2 meetings, at least in my opinion. And on to my 5th point, which is future rate cuts and economic projections. So the big question is, when is the Fed going to cut interest rates? So they have made it clear that they will not cut until they have a confident data where economic growth has slowed down, or there is an unstable labor market, or a threat for recession coming. They will not cut interest rates. And because of that, we don't really know when exactly is that going to happen. And as far as we know, like I just said, economic growth seems solid. This is why next week's meeting is going to be so particularly important, because they're going to review their summary of economic projections, which is SEP. And this is important because they will review whether they are still on with their plan, which is having 3 cuts this year. And based on how it looks like, because there's only about 4 meetings left this year, it seems highly unlikely. So after this SEP report, we should be able to see whether they're going to still decide to cut 3 times this year, which I already said is highly unlikely, or they're going to cut lesser times, or they're not going to cut at all. And they're going to reveal their view on inflation and any sort of future actions they might look into. That's why next week's meeting is going to be more important to the economy than the past few meetings. Anyways, now on to my conclusion. So in summary, the meeting next week on June 12th may seem insignificant or non-eventful, but it is actually highly important, and we will get some insights on what the Fed would want to do in the course of the next year, and how it would affect your life financially. So we gotta stay tuned to the Fed's meeting, keep informed. There's gonna be good insights, and I'm gonna report about it to all of you. And because based on the decision of the Federal Reserve, it will affect mortgage rates and the stock market as well. So I'll keep you guys informed. I hope you guys like this video. I hope you like and subscribe. I hope you comment down below your thoughts, and I do hope to see you again in the next one. Bye.